There is a line in the sand right now on US dollar to Japanese yen that most retail traders are completely misreading. We have a 1-hour chart screaming strong sell, yet the daily, weekly, and monthly candles are all flashing strong buy. That is not a contradiction, it is a trap. The kind of trap that liquidates over-leveraged shorts and then immediately crushes breakout chasers. Today, I am going to map that trap for you. I will give you the one danger zone and the one hidden opportunity. And if you stay with me until the trade setups, I am handing out 3 exact entry and exit levels that you can place right into your platform. This is your Alpha Market Meridian daily breakdown for US dollar to Japanese yen. Let's get into it. Right now, US dollar to Japanese yen is trading at 159.19. The Asian session gave us a gentle drift lower, which is exactly what the 1-hour strong sell signal ordered. But look at the higher timeframes. The 5-hour chart is neutral, refusing to tip over, and the daily chart is an absolute fortress of buying pressure. Here is your instant market verdict for today's session. The dominant bias remains bullish, but we are in a tactical fade while respecting the trend environment. That means we want to buy weakness into proven support, not chase strength into resistance. The one invalidation level that proves this bias dead wrong is 158.87. Write this number down. If US dollar to Japanese yen accepts price below 158.87 on a 4-hour candle close, the short-term structure flips, and we are likely heading for the 50-day moving average zone near 158.39, possibly even a deeper wash towards the 100-day MA. But if 158.87 holds, and I believe it will, every dip is a reload for the attack on 159.71 and then 160. That is the simple, brutal logic of today's flow. Comment below right now. Drop the number 158.87 if you understand how powerful that line is. I want to see who is paying attention. Let's walk through the technical architecture step by step, because this is where the real edge is. I'm going to take you from the monthly monster trend all the way down to the 60-minute noise, and I want you to visualize the chart as I speak. On the monthly time frame, US dollar to Japanese yen is a strong buy. We are riding a multi-year bullish structure that has the 200-month moving average sloping higher far below us. This is not a trend you fight. The weekly chart confirms with strong buy conditions as well, and here is a critical detail. The weekly MACD is still expanding higher without any bearish divergence. That tells us momentum is intact. The weekly 20-period MA is dynamic support and sits well below current price, somewhere in the mid-156. That means the trend is stretched, but not exhausted. Now drop to the daily chart. Daily strong buy. The 200-day moving average is at 155.74, acting like a massive concrete floor. Price has not touched that average in months, which tells you how one-sided this move has been. The 100-day MA is at 157.45, the 50-day MA at 158.39. Both are sloping up aggressively. Today's 20-day MA rests at 158.78, and the 10-day MA at 158.93. Right now, spot is trading at 159.19, so we are above all these major daily averages. That is textbook bullish alignment. But here is the nuance. The 5-hour chart has moved to neutral, and the 1-hour chart is actually showing a strong sell signal. Price has slipped below the 5-hour MA of 159.22, and the 1-hour momentum oscillators are pointing lower. The MACD on the 1-hour is barely positive at 0.160, but the histogram is shrinking, signaling a loss of upside speed. The RSI at 54.7 on the hourly is not oversold yet, so there is room for further intraday weakness without breaking the bull structure. That is exactly what we want to see for a healthy dip buy. Here is what most traders miss. When you have a strong daily buy trend and an hourly sell signal, the most profitable pattern is a shallow pullback to a stack support zone that refuels the larger trend. Our stack support zone today is between 159.02 and 158.87. 159.02 is the immediate pivot, and 158.87 is the lower guardrail that coincides with the 10-day MA area. If price gently tags that zone and then prints an hourly bullish engulfing candle or a sharp MACD turn, that is the confirmation the institutions are stepping in. On the resistance side, the immediate hurdle is 159.71, which is the recent swing high and a major liquidity magnet. Above that, 159.86 is the next extension. If we clear 159.71 with conviction, the run to 160 becomes a near certainty because stops will be clustered above that high and the round number will act as a psychological target. Remember, the 160 level is not just a number. It is the line where verbal intervention from Japanese authorities becomes a near guaranteed headline. That is where the game gets dangerous and profitable at the same time. Let me tie in the Nikkei 225 crosslink right now because it is screaming a message that US dollar to Japanese yen traders cannot ignore. The Nikkei has been trading with remarkable resilience, holding its own near elevated levels. When the Nikkei is bid, it signals that risk appetite is alive and the carry trade is well supported. Japanese equities and yen weakness are joined at the hip. Exporters benefit from a weaker yen, and global investors chasing Nikkei returns are implicitly short yen. Right now, I am seeing no divergence between Nikkei strength and US dollar to Japanese yen strength. They are validating each other. That mutual validation dampens the odds of a sudden yen surge unless we get an external shock. If the Nikkei were to roll over hard while US dollar to Japanese yen holds high, that would be your early warning of a risk-off yen repatriation event. But we are not there yet. This alignment gives me confidence that the dip buy structure is the correct play. Now, let's bring in the fundamental driver that is quietly setting a trap under this entire market. In the last 24 hours, the core news is HSBC's call for 2 BOJ rate hikes this year. 2 hikes. That is a punchy forecast against a consensus that barely prices one full move. On the surface, that should be yen positive. But look at price action. US dollar to Japanese yen barely flinched. It is still clinging to the 159 handle. This tells you that the market is deeply skeptical. The intervention ghost is always there, but traders have been burned repeatedly fading this trend. The yield differential between US and Japanese bonds remains an ocean, and until the BOJ delivers something concrete or the Fed genuinely turns dovish, the path of least resistance is higher. However, HSBC's call plants a seed. If upcoming Japanese inflation data or wage numbers surprise to the upside, the 2-hike narrative will gain traction fast, and that could trigger the very 158.87 breakdown I flagged earlier. So the narrative web is this. We trade the bullish technical structure until the macro story forces a reprice. That reprice would be a 4-hour close below 158.87. Until then, the trend is your friend, but you must respect the intervention risk as a volatility amplifier on spikes above 160M Y1 to 2-week directional lean is cautiously bullish, targeting the 160.50 to 161.00 zone, but with a hard stop on a weekly close below the 50-day moving average at 158.39. That would signal the trend is cracking, and I would flip to neutral or short against 160. Most people will click away right now, but this is where money is made. I am about to give you 3 precise trade setups for today's session. Keep watching, because I guarantee one of these will match your risk profile and save you from emotional entries. Let's go. Strategy 1, the sniper. This is the conservative play, designed for high probability and clear risk management. We will wait for a pullback into the support zone. The exact trigger condition is a 15-minute candle close above 159.05 after prices tested and held the 159.02 to 158.87 demand area. We need to see the 15-minute MACD curl up from below the zero line, confirming momentum shift. Entry on the next candle open. Stop loss sits at 158.72, just 10 pips below the 158.87 invalidation level, giving a buffer for noise. That stop is also below today's 20-hour MA cluster. Logic is simple. If price breaks 158.87, the setup is void. Target 1 is 159.50, which is intraday liquidity towards the recent swing high. That offers roughly a 1 to 2 risk-reward ratio depending on precise fill. Target 2 is 159.70, just ahead of the 159.71 resistance. Once target 1 is hit, move your stop to break even. This setup is voided if price does not hold 158.87 during the pullback and instead dumps through it with a decisive hourly candle. Strategy 2, the active trader. This is for traders who want to capture the momentum confirmation without waiting for a deep dip. The entry condition is a breakout and retest of 159.22, the 5-hour MA, on the 30-minute chart. When spot reclaims 159.22 and holds above it for 2 consecutive 30-minute candles, that signals the intraday sell pressure is exhausted and the daily trend is reasserting. Enter long at the candle close of the second 30-minute candle. Your stop loss goes at 158.95, which is below the session low and below the 10-hour MA. This gives the trade room to breathe without exposing you to the full structural breakdown. Stop reasoning. A move back below 158.95 would indicate the bounce failed and the 1-hour strong sell is regaining control. Target 1 is 159.71, the key resistance. That provides a solid 1 to 2.5 risk reward. Target 2 extends to 159.98, just a whisker below the psychological 160 barrier. After target 1 is reached, implement a trailing stop of 20 pips. This locks in profit while letting the runner chase the breakout. This setup is high confidence only if the Nikkei remains positive or flat during the US session. A sudden Nikkei sell-off would degrade the probability. Now, before I give you the aggressive third strategy, I want to see how aligned we are. Type your US dollar to Japanese yen range for tomorrow in the comments right now. I am looking for high and low estimates. I read these every day, and the best calls get a shout out in the next video. Drop your range. Let's build this community of serious traders. Strategy 3, the aggressor. This is high risk, only for those who know how to lose small and manage risk like a professional. This strategy exploits the very breakout that traps latecomers. We are looking for a momentum spike through 159.71 on the 5-minute chart, accompanied by a volume surge. The entry is a market buy on the break of 159.71, but only if the 5-minute candle closes above that level and does not immediately wick back. Your stop loss is incredibly tight at 159.45, just below the breakout point. The logic is that if this is a genuine breakout, it should not retrace deeply. A drop back below 159.45 invalidates the momentum and likely signals a bull trap. Target 1 is 160.00 flat, a fast scalp. Target 2 is 160.20, where fresh round number resistance and potential verbal intervention headlines will sit. The risk reward on this trade is around 1 to 3 if you are precise, but it requires split-second execution. Explicit warning: this is a counterintuitive play for a market that is due for a pullback. Only take it if you are comfortable with a 30-pip instant stop-out. If the BOJ issues an intervention warning right as you enter, you will be trapped. You must accept that. No matter which setup you choose, let me be crystal clear on risk management. Never risk more than 1 to 2% of your account on any single trade. Do not hold positions through high-impact US data or any unscheduled BOJ announcement. Stops are non-negotiable. If you cannot honor your stop, you are not trading, you are gambling. I want you to survive and compound. Let me close the loop on this entire analysis and point you to tomorrow. The single most critical level for the next session is 158.87. If that floor holds, the path to 160 is open. If it breaks, we reset the board. Tomorrow, I will be watching the Tokyo Open closely because a fresh round of Japanese inflation expectations data is due, and that could be the catalyst that tests our support. That video will be critical, so make sure you are subscribed and the bell is active. And if you want the full breakdown on Bitcoin and the S&P divergence I mentioned earlier, that video is live on the channel right now. Hit the end screen to watch it next. I cover 8 assets with this same level of precision every single day. Smash the like button if this analysis gave you a clear plan. Subscribe if you want to trade alongside institutional thinking instead of retail noise. I'll see you in the next one. This is Alpha Market Meridian, signing off.